Hi everyone, my name is Darryl Panes, CEO of As Good as Gold Australia. And this evening, once again, I'm joined by my brother Brian.
Thank you, Darryl.
Partner at As Good as Gold. And this evening, we speak with Head of Research at GoldMoney, Alasdair Macleod. Good evening, Alasdair.
Good evening. Nice to be back again.
Yeah, well, it's been something like 6 weeks, and every time we speak with Alasdair, we start the same way and say a lot of water has flown under the bridge since we spoke last.
Yeah.
And unquestionably, that has been the case again. Banks, of course, in disarray, and gold and silver have responded accordingly.
Yeah.
And gold's up about 300 an ounce over the last 6 weeks, and silver about $100 a kilo, which is pretty significant.
Yeah, it's probably like, rather than water under the bridge, it's probably like the Niagara Falls under the bridge, certainly in the last week.
Yeah, I mean, like, we have been inundated, Alasdair, and we're not on our own. I know the bullion dealerships in Australia, the mints are under enormous pressure. I mean, it's just everyone wants to get their money out of the bank. And just a huge demand on us at the moment. No one's got enough staff. We just can't keep on top of it. Or we're battling to keep on top of it, I should say.
Pretty well.
Yeah. But all good. We forge on. What I want to do, if I can, Alasdair, is refer to, firstly, some comments that Egon von Greyer's made. And I'd like to quote them because hardly anyone does it like Egon von Greyer's. And so consequently, I'd like to share this with our audience. Egon says, I would like you to comment on this. Egon says, anyone who doesn't see what is happening will soon lose a major part of their assets, either through bank failure, currency debasement, or the collapse of all bubble assets like stocks, property and bonds by 75 to 100%, so it's massive. Many bonds will become worthless, and wealth preservation in physical gold now is absolutely critical. The solidity of the banking system is based on confidence. Well, we all know that, and as he says, with the fractional banking system, highly leveraged banks only have a fraction of the money available if all depositors come in and ask for their money at the same time. So when confidence evaporates, so do the balance sheets of the banks, and depositors realise that the whole system is just a big black hole. And this is exactly what is about to happen. For anyone who believes that this is just a problem with a few smaller US banks and one big one, Credit Suisse, they need to think again. He goes on to say, the banks are falling like dominoes. Silicon Bank's 16th biggest US bank is gone. Signature Bank, 29th biggest, is gone. And yes, the First Republic Bank had to be supported by US lenders and the Fed by a $30 billion loan due to a run on deposits. But as he says, this won't stop. The rot will continue as depositors attack the next bank, the next one, and the next one. Then we have the Swiss second largest bank, Credit Suisse, saved on the bell by an acquisition by UBS, with the Swiss government backstopping the deal. So, Alasdair, how do you think the banking sector is going to cope with this almighty new challenge? And what outcome do you believe this will lead to?
Well, I find it hard to disagree with Egon, I must admit. I might look at the detail slightly differently from him. I mean, there is no, what he says about, banks surviving, if you like, on confidence in their balance sheets, in their operations and all the rest of it is absolutely right. I mean, credit is confidence. All credit is confidence. And money doesn't circulate. And by money, I mean gold. I mean, you and I hold on to gold. That's the money. That, if you like, is the medium of exchange of last resort. Gresham's law, if you like, applies to it. And so, yeah, everything is credit, and credit depends on confidence. I mean, you employ someone to, decorate your offices. They will decorate your offices and then render you a bill. Now, basically, they are giving you the credit for their work until you settle the bill. And what do you settle it with? You settle it with more credit, which is effectively a transfer from your deposit at a bank to your creditor's deposit at their bank. You do a bank transfer, or you do it in notes or whatever. But even bank notes are credit. I mean, we have, if you like, the legal position is absolutely clear, and it's still on our banknotes, though it's not honoured in any way. You look at a British banknote, a banknote from the Bank of England, and it's signed by the chief cashier, who says, "I promise to pay the bearer on demand the sum of," and then the value of the note. Now, that writing has got smaller and smaller every time they've issued new notes, but it's still there. And actually, what they're referring to is that the Bank of England promises to pay you 1 sovereign for every pound of face value of that note. They don't do it anymore, but the promise is still there, and that is the legal position. So it is credit. I mean, I find it extraordinary that some people don't think banknotes are actually credit. They confuse it with money. But there is a counterparty risk, and the counterparty risk is with, if you like, the central bank. And you are assuming the central bank can honor its commitments. Okay, we know that it's no longer prepared to release gold into your ownership. They would rather hoard it themselves. I mean, why is it that banks are increasing their gold reserves all the time? They're not giving it to us. No, they're keeping it for themselves. So everything is credit. And we are getting reminded of this now that interest rates have risen substantially. That long-term trend, which started 4 decades ago, of declining interest rates, which have fueled a credit bubble, that's come to an end. And as far as the few bank failures we've seen so far, what it'll have done to every other bank is it will have alerted the management to look at their counterparty relationships within the financial system, and particularly counterparty arrangements within wholesale money markets. I mean, you'll be sort of looking at, which banks are risky. You'll be cutting all your lines. I mean, the way in which the interbank market works, which is the wholesale market, is that each bank will have credit line maximums exposure. It runs files on every bank. So, Bank A here, when it looks at its dealings in the money markets with Bank B, it will have on the file for Bank B, and this is probably an electronic file now, credit limit, $10 million, bang, and that's it. So in other words, the dealers on your wholesale money market desk will not be permitted to go over that level. So what do? We reduce them all down now. We're not prepared to get into counterparty relationships of, say, more than $5 million, where it was $10 million before. And the other thing I will be doing as a bank manager is I will be looking to eliminate positions with banks which I would deem to be risky counterparties. So I would tell my dealers in the wholesale money markets, do not, under any circumstances, deal with the following banks.
Right.
And what else would I be doing? I will be looking at my balance sheet, and I'll be looking at the maturity of the bonds that I hold, if you like, as sort of substitutes for liquidity on the asset side. And anything with a maturity of more than 1 year, I'll sell it if I can. If it's listed in the market, I'll sell it. Because, at the moment, you go out along the yield curve, the coupon that you're getting is less than the cost of funding. Why? Because the Fed and every other central bank has raised their basic rates so that your cost of funding in the market has gone up, and it's gone higher than the coupon return on your bonds. This is what killed SVB. So, you'll be looking at that. You'll be looking at loan arrangements. You'll be looking at even long-standing business customers who have relied on you to provide sort of short-term liquidity, overdraft facilities, if you like. You'll be looking at cutting those back. You'll be looking at increasing the rate. You'll be paying huge attention to the bank's image in the market, because you do not want to find depositors moving out of your bank into another bank. So if you raise the deposit rate, you do not want to send a signal that the reason I'm raising my deposit rate is because I need your bloody deposit. You see what I mean? So you can see, to summarize it, every bank is now in a position where, instead of being driven by greed, whereby they expand their balance sheet and they make 15, 20 times their margins at the shareholder level because of balance sheet gearing, they're now bringing it back in. They're reining it back in. And I would not want to publish accounts now showing, shareholder leverage relative to assets of more than, I don't know, sort of whatever, 10 times, something like that. So if I'm 15 times or 12 times, I'm going to start cutting it back. Now, it's not just me doing this. I know that everybody, when I go to the bankers club for lunch, this is the topic of conversation with all my mates in the other banks.
Yeah.
What are they doing? They're doing exactly the same thing. So what we have is contracting bank credit. Now, contracting bank credit will expose the weaker banks. Of that, there is no doubt at all. So this bank crisis is not over with Credit Suisse, and it's not over with Silicon Valley Bank. It is something which the Fed is trying to patch up. They have paid huge attention to trying to deal with this situation. They worked in the earliest stages with the Swiss National Bank to ensure that there were swap lines sufficient to stop a complete failure of Credit Suisse. Now, basically, they have managed to do that. They have lent on UBS.
Yeah.
And even though UBS refused to take them over before, they lent on them so hard that UBS really had no alternative. We're talking about one member of the establishment getting another member of the establishment, in other words, a central bank getting the largest bank to rescue. It's rather like the Fed using JP Morgan as its conduit into the commercial banking network. So you can see that they pulled out all stops. But the interesting thing is that the Swiss National Bank made one mistake in all this, and that is they used their legislation, which they'd put in place following the Lehman crisis, in the same way that every other G20 member nation did, to bail in the senior note holders. Now, these senior notes are regarded as part of the bank's capital. What happened was that shareholders get something out of the Credit Suisse takeover, but the bondholders got nothing. This turns company law completely on its head, because the bondholders should actually be ahead of, rank ahead of equity holders. So this was a big mistake, and what it did was it shook, the bank capital markets in Europe as a whole, because there were lots of these loans around, and you begin to think, oh my God, if the Swiss National Bank does that, then should we be owning Deutsche Bank's equivalent? Should we be owning Commerzbank's equivalent or BNP's equivalent? Whatever. So you can see that this actually caused shockwaves throughout Europe. And I think also it calls into credibility the Swiss reputation for probity and all the rest of it. And that's a subject you might like to discuss next time you talk to Egon. But you can see that there was a big mistake there. Now, what the Fed has also done for the Silicon Valley Bank, the Silicon Valley Bank was a different problem from Credit Suisse. What they did was, when interest rates were at the zero bound, they could borrow at close to the zero bound. I mean, they weren't paying their depositors any interest at all, so they could, do whatever they wanted to do to attract depositors, which really came out of the tech industry, which was, busy funding itself. Shareholders' funds. Okay, you get $100 million from a share issue, you bang it into SVP as a deposit, okay, until you spend it. Fine, absolutely fine. But the problem was that the SVP took that money and invested it along the yield curve, because at that stage, the deposit money was costing them nothing.
Yeah.
And they were able to go out along the yield curve and pick up, say, a 10-year US Treasury yielding 1.5%. So, that was the best deployment of money at that time for a bank which was absolutely flooded with deposits. But then when interest rates rose, their profit and loss account showed that the cost of funding was considerably higher than the coupon they were getting on their debt. And worse than that, the mark-to-market value of the US Treasury 10-year note that they'd bought had fallen something like 30%. They lost 30% of the capital on the balance sheet. And, their problem really started when, a few guys on the inside saw what was happening and thought, this is not good. And so they started bailing out of their involvement with the bank, either as shareholders or as depositors or, loan note holders or whatever. And it got to the point where this became rather obvious. And rather belatedly, Silicon Valley Bank decided that they needed to go into the capital markets and raise a couple of $1 billion to shore up the balance sheet. And of course, the market suddenly said, oh, whoa, hold on a minute. What's going on here? This bank's in trouble. When you actually look at it, you can see that it's in trouble. And so that was the end of the bank. And this is not the only bank that did this. It is as a result, it's the unintended consequence of monetary policy of suppressing interest rates at the zero bound. And if you think this problem is confined to America, forget it. I mean, in Europe, it wasn't the zero bound, it was negative. In Japan, it is still negative. They're desperately sitting on rates, trying not to let them rise. Because, the whole banking system starts falling over because they're all up to their necks in debt, which is falling in value, government bonds, agency bonds, whatever it might be. So we can see the extent of the problem. The problem has not gone away. But worse than that, I return to the situation where you as a banker are looking at your own situation. You have sacked anyone who's thinking about greed, and you're now run by fear. So you are contracting bank credit. Now, what drives interest rates? Is it the Fed? Is it the Australian National Bank? No. It's the cost of bank credit. And we're talking about commercial bank credit. If I'm desperate to continue to fund my business, like, I don't have enough income coming in to pay the bills and I'm relying on the bank to tide me over, I go to the bank and I say, look, I do need to borrow another $1 million. The bank will it'll say either of two things. First reaction will be, because they're trying to contain their balance sheets, no, sorry, we can't help. But if it appears to the bank that if they don't help just a little bit, then, their exposure to you could actually be completely undermined, they're going to turn around and say, well, you want $1 million, we will let you have $500,000, but the interest rate is 15%. That is what is setting the interest rates now, not the central banks. So you can see that central banks have lost control of interest rates completely. And the consequence of contracting credit is to raise the cost of credit. And this is a point which people are only gradually beginning to wake up to. So the idea that, what the Fed has been doing and every other central bank is they've been telling us that inflation is disappearing. It's going to diminish and we're going to go back to 2%. Maybe not in a year as we originally thought, but 18 months or 2 years, it's going to go back there. So there's no need for us to raise interest rates other than maybe just a little bit. That's the official line. But they don't have control over interest rates. And I can tell you, when people wake up to the fact that they've lost control of interest rates completely, and it's actually in the hands of commercial banks who are withdrawing credit rapidly from the system, you can see that there is a huge, huge shock yet to be understood. And so the question then becomes, what is the Fed going to do with this situation? Well, having lost control of interest rates, what they're trying to do through this bank term lending program thing, which they set up, which I'd better tell you a little bit about. Basically, under this program, what they have said is that we will lend a bank, and it's only for banks. We will lend any bank on on our list, as it were, American banks or foreign banks which actually have an account with the Fed. We will lend you for 1 year at a rate which is very, very close to the Fed funds rate, money. But we will need collateral in the form of government or agency debt. But we will take that in at its face value with no haircut. So what this means is that me as a banker, I can go into the market and I can pick up, say, a 10-year US Treasury with a 1% coupon, probably at 80 cents on the dollar. Shove it into the Fed at 100 cents on the dollar, take the money and put it into Treasury bills at a similar rate, or maybe even with a small margin, over the Fed funds rate. Now, okay, this is not, if you like, a profitable credit deal in the banking sense. But what it is, it's a fantastic arbitrage between market prices and what the Fed is prepared to take the stuff in at. And at the end of the year, I could just simply match it. What I could do is I could say, I can do two things. I could say, right, okay, I'm going to buy 1 year US T-bill, which will yield me, at the moment in this market, just slightly more than the Fed funds rate. And I just match it. Okay, it's sitting there sterile, but what else am I going to do with it? Am I going to lend it to Brian and Darryl? Because they need the bloody money? No, I'm not. I'm going to, this is the safest thing for me to do. It's manna from heaven for a bank. It'll help defer the problem for banks that have the problem of the Silicon Valley Bank. But then the question is, what happens at the end of a year? Because this is in essence an extension of quantitative easing. Because what the central bank is doing is it's injecting credit into the economy, into the banks. So it's not circulating credit, but it's going into the banks. It's exactly the same in a way as quantitative easing. So we've seen what happens when they try and quantitatively tighten. It just screws up everything. So are they going to reverse this? Well, that's going to be an interesting one. I suspect that as time goes on, this 1 year facility sort of rolls, as it were, I think more and more banks will realize that actually they can take this stuff off the Fed at an interest rate which is lower than the real rate of interest which is set between bankers and their customers. This could become actually a relatively attractive source of balance sheet funding. So what you've got is the replacement for the contraction of bank credit is the expansion of central bank credit. Now, when you expand central bank credit, that is the credit which all other credit is tied to by value. And we know that when the central bank expands its balance sheet, the inflationary consequences are considerably more obvious to everybody than, I mean, inflation in the sense of loss of purchasing power of the currency, than the fluctuations in commercial bank credit. Everything takes its cue from central bank credit and changes in its quantity, changes, if you like, in the confidence in the central bank. And remember that the central banks themselves have the Silicon Valley Bank problem in spades. I mean, they've all bought their government bonds and agency debt at the very top of the market. And worse than that, they created the top themselves far higher than the markets would have created under their own volition. So we have this situation really where the central banks themselves are, they're stuffed full of debt at totally the wrong price. The losses are unimaginable. And the Fed's response to this is to get in even deeper by lending money to banks to take debt out of the market and effectively suppress the yield curve to make funding affordable for the governments. I mean, that's the other side of it. You can see the conversation. How do we come up with a solution? Well, this is a solution that will get the banks which have done what SLB have done, get them out of trouble. And at the same time, if we manage to get banks into the market to buy up debt and increase its price, in other words, lower its yield, then it's going to be easier to fund the government deficit at a time when the foreigners seem to be leaving us like rats out of, oh no, we can't say rats out of a sinking ship. That would be, but you can see the conversation. You can see how they've ended up with this. And it's rotten. It's completely rotten. Yeah, and the right description is the foreigners are leaving like rats leaving a sinking ship. So there we are. That is a potted version of what's going on, at least my potted version.
Well, I'd like to you've mentioned the Fed a couple of times, and I saw a US senator the other night grilling Janet Yellen, and she really did appear to be under pressure, and Janet doesn't perform all that well when under pressure. Yeah. And he said, his question to her was, okay, we've got banks at the moment that are looking very uncomfortable. What are you going to do? How well are you going to support these banks that are distressed? They're vulnerable. And she said, well, we're going to assist the big banks. There is limited resources, but we will support the big banks totally. The senator said, well, okay, that's all right. But he said, I live rural. What are you going to do to support the smaller commercial banking sector? She said, and with hesitation, but she said, we're going to support the big banks. Now, the point here is, and I saw Andy Schechtman make remarks on this as well, because he said, well, surely that's going to drive people away from the smaller banks because they're not going to be supported by the Fed. So they could easily, if there was a bank run occurred, easily go under. And that makes an enormous amount of sense. And I'm sort of thinking to myself, well, surely the Fed would realise this. They would know that. I mean, they're intelligent people, I think. Right? Surely they would know this. So is this by design? Do they want, or is their preference to see the small banks go under? Because at the end of the day, and I guess we get back to, CBDCs, the potential there, or banking digital currency, it's easier to manage an operation when you're working with a small group of big banks than it is a vast array of much smaller banks. So what are your thoughts there? I mean, Andy Sheckman and Robert Kiyosaki were talking about this, and they seem to be very disturbed at the time. You can normally tell when someone's got a quiver in their voice and they're saying, look, we're scared for Americans. In fact, Andy said, I'm scared for me. Do you think what we're discussing here should have Americans feeling scared at the moment? And the rest of the world?
Undoubtedly, concerned, I would certainly say. The first thing I would say about Janet Yellen's testimony is she's not the only one with this problem. The problem is that as soon as any official in a banking situation, crisis such as this, as soon as they open their mouths, what they say is taken, not the way in which they intended. Now, I have no doubt that Janet Yellen was sort of trying hard to appear responsible by not removing the possibility of banks failing, because you've got a duty to, protecting moral hazard, as it were, just if you see what I mean. So you can see, in a sense, they are very conflicted in terms of the public statements. If you turn around and say, we will support every bank, irrespective of what happens. Now, that's actually what they've got to do. But for them to say it undermines everything. It undermines the currency. The next thing they've got to do is got to go into the market, try and, support the dollar, sell gold to try and drive down perceptions that the currency is actually losing credibility. So it's very difficult. It's not just Janet Yellen. I mean, I can see this with statements from other central bankers. She's a treasury, obviously, but so I think that is the problem. Anything that is said, people then sort of logically deduce, but do we actually believe what these people say? No. I mean, it's always been wrong to believe anything a government official says. So, in that sense, what she was saying, I think, was for public consumption. Let's put it that way. And those of us with a slightly closer analysis of the situation should not take what she says at face value. I think the problem is slightly different, and that is having enacted bail-in laws, whereas before there would be no question it would be bailout, and the Fed learned from letting Lehman go that this is not a good idea. I think that central banks generally do appreciate that they have a duty to ensure the integrity of the commercial banking system, which really means that confidence factor you were referring to earlier, Darryl. That's something that you've got to preserve at all costs. And you cannot be in the business of selecting which bank is going to fail and which is not. So, I think at the end of the day, I think the Fed realizes this. And this is why one of the reasons they've taken the action to stop other Silicon Valley bank failures, banks which have, instead of been in the credit business, have been in the investment business, rather like a hedge fund, if you like, borrowing at one rate to invest at another rate and finding that the whole thing goes upside down. I think the room for error in this is if a central banker somewhere along the line actually hasn't got the message that it is at a time of banking crisis, it is the primary function above anything else for a central bank to ensure the integrity of the commercial banking system. I mean, if you want to talk about whether, we want to save larger banks in the long run at the expense of smaller banks, that is an issue for tomorrow, whatever its merits or demerits. But today, you have got to ensure that no bank fails. But the problem is the politicians can't say that. And Janet Yellen is now a politician. So she was really between a rock and a hard place. So that's my analysis of that.
Yeah, I was about to say that they're damned if they do and they're damned if they don't. But that's the position they've put themselves into, really.
Well, before I add to this, and we're still on the banking situation, the one thing I have learnt over many years, and I'm sure you'd agree with me, Alasdair, you might want to make a comment, but for the Fed or any central bank to bail out banks or other financial institutions, the money has to come from somewhere. And for the life of me, I do not understand why people don't understand the fact that where does this money come from? I mean, we're not talking 100 million, we're not talking 1,000 millions, a billion. We're talking many, many billions of dollars to bail out somebody or a bank or an enterprise that's gone nearly bankrupt. Now, to me, the printing of money, which has to be printed to bail out the ones that go belly up, has to cause inflation. To me, it can't be anything else. So I think there's going to be inflation for a long time to come. Just that point, Alasdair, do you agree?
Yeah, I mean, the way to look at it is actually we're not talking about money, we're talking about credit. And you can expand credit, expand it and contract it as much as you want. I mean, the reason I drew the analogy between, you get someone to decorate your offices there, I mean, that's credit at its most basic level. And the banks are just formalizing that credit and they're given a license to do so. But what we are seeing, and as to your point, Brian, is that the creation of credit upon which an economy really works is shifting from the private sector to government in the form of central banks. And that is destructive of the value of the currency because the credit creator is also the issuer of the currency. So, it is, that's what's going to happen. Now, the people who understand this last are always the domestic users of the currency. I mean, I'll give you an example. If you look at the dollar, since 1971, it has lost 98% of its purchasing power against gold, which is the real money, legal money, by the way. Yet we still use dollars. We still have dollars in reserve for those things that we need to rush out and buy at a moment's notice or whatever. Or we still have the availability of credit, payable in dollars and so on. So we don't realize this as users of the currency immediately. We might, if we're well educated financially, understand the implications as far as our finances are concerned, our financial activities, rather than our day-to-day purchases of goods and services. But the people who really do realize these are the foreigners. If the foreigners own a lot of your currency and they see what the central bank is doing, what do? They get the hell out of it.
Yeah.
And the point about the dollar is that the foreigners, and this is according to the US Treasury's own figures, own roughly $30 trillion of financial assets and cash. And the cash element is a bit under $7 trillion. But the rest is sort of stuck into bonds, which they have been reducing. I mean, the Chinese in particular have been cutting out of US treasuries. I think it's around about 12 trillion in portfolio investment. So there was all that diversification as well. But then the question is, well, if the foreigners start selling the dollar, what are they going to buy? Well, I mean, obviously they buy their own currencies. The reason for doing that is not that your own currency is any better than the dollar, but you're accounting in your currency. So what you need to do is to try and control the risk. So at least you know if you own your own currency, in accounting terms, you're not going to make a loss. Whereas you could make a loss in dollars, and particularly if you see the Fed go, fly off the handle in terms of expanding its credit. So that's the one thing. But I think the one area which is really underappreciated, I think, is commodities as a whole. And I think you'll find that, particularly China and Russia and the whole of that sort of Asian area, which is now all under the, if you like, control of Russia and China, they're just moving towards commodities. And Putin has said as much. He said, why own dollars and euros when he made the speech back in, I think it was June last year in St. Petersburg, to 81 official foreign delegations. He said, why own dollars and euros when their purchasing power is going down at the rate of 6 or 7% annually? Yeah. And why own them when the Americans and the Europeans can just cut you off and stop you using them? Yeah. Which is what happened to Russia. The message was loud and clear. And he also said, why do you store your gold in their vaults? You've got to get out. The message was absolutely loud and clear. And I think what it means is that we will see a substantial move out of fiat currencies into tangible commodities, things like that. And as to the point as to how those commodities are going to be deployed, China and Russia and the Shanghai Cooperation Organization are embarking on an industrial revolution, which is far larger than anything we have seen in our history. Its importance is not as great, perhaps, as the British Industrial Revolution, but in terms of the numbers of people who are going to have an enhanced standard of living, the increase of wealth and everything else is, we're talking about 3.8 billion people being fed by commodities in Africa for a further billion people, and also perhaps another 500 million from Latin America. Why? This is an interesting one. Why are Argentina, I'm probably wandering off subject a bit, but why are Argentina and Brazil now looking at setting up a joint currency? Yeah. Well, they realize their currencies aren't fit for purpose in this new world, so they need to have something which is separate from the political concerns for which they use their domestic currencies, like, printing pesos or reals in Brazil in order to finance the government's needs and wants. We have a separate currency which we can use just purely for trade. Well, the answer is link it to gold. What's the problem? So you can see that escape routes from a collapsing fiat currency world, which is our world, these escape routes are going to be created, as well as the need for the commodities, the stockpile commodities, because of what's going on in Asia. So this is, I think, a very important time in our lives as to, the whole thing. We've got a collapsing banking system in the West. And the amazing thing is that I was looking at the share prices of the Chinese global systemically important banks. And while ours were collapsing, theirs were rising. Yeah. I thought that told the whole story, really. Anyway, there we go.
Yes, it does tell the whole story. Yeah. Before we go on to the subject of the gold price, and I won't be talking about what you think the price will be, but there will be some points on that. But just on this last one, before we move, it's been said that the market is expecting up to 4 interest rate drops by the end of 2023. I just can't believe in that. But your thoughts? Do you think there are going to be any interest rate drops between now and the end of the year?
What we're looking at is investment strategists, central bankers, whatever, who are all Keynesian. They don't understand that the relationship between interest rates and prices, or changes in interest rates and prices, is actually immaterial. It doesn't work like that. It really doesn't. So we're starting off from a point of myth, if you like. So that's the first thing I would say. The second thing is that we can see that the pressures for prices to continue to rise, the previous pressures. I mean, for example, the sudden increase in oil prices when the Russians invaded, that is now behind us, and it's all statistically falling out of the back end. On top of that, things like supply chains are beginning to work again, and so on. So you can see that the production cost pressures are diminishing a bit. So we can see that it could be, if you're live in the world of wishful thinking, it could be that those wonderful people at the Fed and the Bank of England and and the Reserve Bank of Australia, whatever, are right that inflation is going to come down and therefore interest rates are going to come down. So yeah, that's why people expect interest rates to come down.
Right. Okay.
But here is the shock. And I make this point time and time again. Interest rates are not being driven by central bank policy. They're not being driven by the commercial banks' attitude to lending. And you're not going to see the drops. I mean, I don't give a damn what happens to the so-called inflation rate. If commercial banks are withdrawing credit from the economy and they're over-leveraged, and you can see that it becomes a self-fulfilling prophecy, because not only are your banking relationships in the wholesale market falling apart, but that bad debts are mounting everywhere. They're mounting everywhere partly because of interest rates have already gone up unexpectedly, but also because you can see from your own intelligence in terms of talking to businesses and so on and so forth that things are the economy is going into contraction. Do you want to be lending into a contracting economy? No, you don't. So you're going to continue with your anti-greed, more driven by fear approach of trying to reduce your balance sheet. We can see that. And that, I think, is, the way I'd answer your question is actually, it's got very little to do with the inflation rate now. It's all to do with what happens with credit. That's the thing we've got to focus on.
Okay. Well, Darryl, I can certainly add to your commentary there with a lot of truth, because a long time ago we were in manufacturing. So we've been investing in bullion for 25 years. But some of that investment time was when we were in manufacturing. But we had a couple of years. Not all businesses have got growth, like a staircase. Get some downers every now and again. And I know when we did approach the bank, it's about 25 years ago, we approached the bank because we needed some extra money. Well, they'd give it to us. It wasn't at a low rate. It was at a very high rate. So, what you're saying is perfectly true. They're not going to be giving businesses a heap of money at a low rate. It's going to be very high. Okay.
Yep.
Okay, the gold price. Okay, the gold price for the end of 2023 has been tossed around by many analysts, including a large bank, at about $2,500 US an ounce gold. Right, that's equivalent in Australia. That's about $3,750 an ounce. Now, with the present banking debacle we have at the moment, would you consider this price of $2,500 US an ounce to be on the low side? Because I would. To be on the low side. And with silver at 84 to 1, do you think that's going to come down as well? On those 2 points, what do you think?
Well, I always look at it the other way around. I don't look at the gold price as being something that's rising. I look at the purchasing power of the currency in which you're pricing it going down. So
Of course.
my assumption always is that gold has a constant value, because that's history. Now, I know in a crisis that is wrong. And I know that in a crisis, what you find is that people just get the hell out of the things that are falling, like credit, and, will buy gold. So the purchasing power of gold at that stage, measured in goods and services, does rise. That's the key point. So what we're looking at the moment is at what speed. I mean, this is the question really that I think you are asking, in effect. What is the speed of the deterioration of the purchasing power of the dollar, of whatever? And I think of the fiat currencies, we're beginning to see that their purchasing power, there are reasons to expect their purchasing power to actually fall quite significantly. Now, as to whether that's going to happen in the next month or the next year, is a matter, if you like, of how the future unfolds. I mean, looking at the way these currencies are going, the way credit is going, I can see their purchasing power falling very, very rapidly. Once it starts going, it will start going very, very rapidly. So, I mean, whether this means that the dollar price of gold goes to 2,500 or whatever, I'm sure in time it will, but don't ask me to put it. But, really what we're looking at is not the gold price rising at this stage, but what we are looking at is
deterioration of the US dollar.
The deterioration of the fiat currencies. I think that's the key point. I noticed that in Australian dollars, gold is currently 2,940, new high.
Yeah.
No, it's not a new high for gold. It's a new low for the
Australian currency. It doesn't buy much. My wife keeps on telling me I can't buy much with this.
No. You asked the question about silver. As the purchasing power of currencies fall, what tends to happen, the relationship between gold and silver, is that the gold-silver ratio comes down. Now, if we go back in history, silver has been very much the poor man's money. I mean, I think actually a better description of it is, if you go back to the gold standard which was set up under Lord Liverpool in 1817, silver was legal tender for amounts of up to £2. We're talking about coin, and the coinage was pure silver. It was sterling silver, which is 92% or something. So that was the extent of the legal tender, if you like, under that arrangement. But it's been legal tender, accepted as money elsewhere. I remember when I first went to the Persian Gulf back in the 60s, Maria Theresa dollars were still circulating as money. And it was money that they used, when tourists came along and were prepared to pay over the odds. They would melt them down and turn them into signet rings or whatever. Yeah. But it was basically money. So, it's not so long ago that it really was money. And I see that the Indians have been buying silver hand over fist. It's also got the industrial use. So I would say that in terms of its industrial use, it's probably significantly undervalued. It is not priced as money. For it to be priced as money, what we are looking at, I think, is a return towards the gold-silver ratio levels, which pertained when it did circulate as money, even though it was only money for amounts of less than £2. Remember, £2 is 2 sovereigns. That today, 2 sovereigns is £800. So we're talking about silver being circulating as money to up to £800 in today's money,
right?
Today's currency, rather. So you can see that, and I think what happens is that when the gold price rises, measured in fiat currencies, then the price of silver rises at roughly twice the rate, or slightly less than twice the rate. So if we see the dollar price of gold going up to, say, $2,500, something like that, then I would expect the gold-silver ratio to fall quite significantly. I don't know. I mean, you can almost do a mathematical calculation, but for those looking just to sort of profit, if you like, in dollars rather than regarding gold or silver as money, then you might see the conditions move so that they become the gold silver ratio falls to something like 30 or 40. Now that would mean an outperformance of silver versus gold, roughly 2 times. So I think from a purely monetary point of view, it's actually not a bad idea to have some silver, because when paper currencies really do collapse, you're going to need what they call poor man's money. The small change, small change up to $1,500 or whatever it is, whatever the equivalent of £2 in 1817 in the UK was.
Yeah. An ounce of silver will buy a lot more than what it will today. A lot more. Yeah.
Fantastic information once again. I mean, we've got about another dozen questions to ask you, Alasdair, but we'll have to save it till another time. And
for another time.
But once again, I mean, just fantastic information. I mean, it reminds me so much, and we keep referring to Charlie Tremendous Jones, of course, who used to say, in 10 years' time, you're going to be in exactly the same position you're in right now, apart from 2 things: people you meet and the books you read. And connecting with Alasdair Macleod, I mean, anyone who's watching this interview tonight should take advantage. It should be so obvious. Take advantage of people like Alasdair Macleod's knowledge, and because you will be a much smarter person in the process. And we've been very fortunate, Brian, that we've been able to connect with people like Alasdair. Peter Daniels has been a great mentor to us. But, the interesting thing about all of these people, and whether it be Egon von Greyers, Jim Sinclair, or Jim Rickards, they are all great supporters of gold. Peter Daniels introduced us to gold many years ago, and he was the number one real estate entity in the state of South Australia, and a big player in Australia. But he said, you've got to own gold. You must own gold. And his whole family, Alasdair, the 2 sons, the daughter, have now educated their children on holding gold for all the things that we talk about all the time.
That's 25 years ago when we were first introduced to the concept of holding gold.
Yeah. And it's been a huge asset for us. We've fully taken advantage of that knowledge. But I plead with the viewing audience, take heed and listen closely to what Alasdair had to say tonight. Replay it a dozen times if you have to, and just get the message, because it's really important now more than ever before. It's important to own gold. Egon von Greyers, of course, got a pretty good response to that, hasn't he, Brian? Whenever asked the question, how much should I invest in precious metals? What does he say?
What does he say? Whatever you cannot afford to lose. And it's a darn good answer.
It's a wonderful answer. That's how much you put in a precious metals. So, Alasdair, thank you so much. Really appreciate your input again, as is always the case. We'd also like to thank our audience, for our viewers, subscribers, for supporting this channel. And so until next time, if we all stay well, stay focused, goodbye for now.
Goodbye for now.